Chapter 9 is Peter Lynch's catalog of the types of stocks he personally avoids and why. The central warning is simple: popularity is perilous. The hottest stock in the hottest industry, the one everyone in the carpool and on the commuter train is buzzing about, is precisely the kind of security you should treat with extreme caution. Hot stories and frenzies lift prices far above sensible measures of value, and when the tide turns, those prices collapse quickly, usually faster and farther than new buyers expect. Lynch opens with the example of a teleshopping mania that shot a stock from $3 to $47 in a little over a year and a quarter, only to plunge back toward its former low. He stresses that when a business is being priced by hope and publicity, rather than earnings and the balance sheet, the investment resembles a roulette spin more than a sound business decision. Hot industries attract imitators, newcomers, and a flood of capital, and that competition often destroys margins. Lynch points to carpets, disk drives, oil services, and other sectors that were once the darlings of Wall Street, and then became nightmares for investors because too many companies rushed in chasing the boom. A related trap is buying a company touted as the next of something famous. When every pundit says the next IBM or the next McDonald's, the claimant is usually an imitator who will never match the original's advantages. Frequently, these copycat stories mark a peak in sentiment rather than a durable opportunity. Lynch illustrates this with retail examples where Circuit City succeeded, but a string of would-be imitators collapsed or gave back most of their market values. Another recurring danger is what Lynch calls diversification, the tendency of companies with excess cash to make ill-considered acquisitions that do not fit their core skills. Management sometimes prefer the excitement of acquiring over the dull discipline of buying back shares or raising dividends. The result is a transfer of value from the original shareholders to sellers of the overpriced assets. Lynch contrasts two shoe companies, one that diversified thoughtfully and built lasting value, and another that bought wildly and ruined its fundamentals. The lesson is to prefer firms that allocate capital sensibly, or at least to be skeptical when the corporate story shifts toward unrelated acquisitions. Lynch devotes a large portion of the chapter to whisper stocks and speculative longshots. These are the companies with the miraculous cures, the revolutionary fuels, the high-flying technology language, and the breathless private tips that arrive in lowered voices at cocktail parties. He admits he has bought some of these, often for small amounts, and uniformly lost money on them over the long run. The common pattern is emotional appeal without substance, no consistent earnings, no reliable margins, and a story that sounds better than the facts. Lynch's rule of thumb is to wait. If the opportunity is really as transformative as claimed, it will show up in the financial statements later. Your risk is much lower if you buy after the company proves it can earn money. Customer concentration is another red flag. When a supplier sells a large share of its goods or services to one customer, it becomes vulnerable to contract cancellations, price squeezes, and abrupt margin erosion. Lynch reminds readers that a once dependable supplier can be crippled overnight if its major client decides to make the product in-house or switch vendors. He therefore prefers companies with a diversified customer base or where the supplier enjoys clear pricing power. Names and image matter too. Flashy, trendy names tend to attract attention for mediocre companies, while dull, clunky names often hide durable businesses because they repel the trend-following institutions. Lynch repeats his earlier advice to treat a goofy or boring name as a potential favorable sign rather than a reason to mock the investment. The practical takeaways are straightforward. Avoid buying into mania because timing those peaks is nearly impossible. Be wary of speculative long shots until the company produces earnings. Resist the lure of imitation stories and the next labels. Watch how management deploys excess cash. Share buybacks and dividends are often more shareholder-friendly than flashy acquisitions that have no strategic fit. Finally, insist on real evidence of profitability, customer diversification, and a durable niche before committing significant capital. If you keep these cautions in mind, you will be better positioned to spot genuine opportunities and to steer away from fashions that reward publicity more than profitable business models.